The pedestrian markets of the summer seem to be well and truly over, with volatility in equity markets really picking up this week, as we can see from the Dow chart here. That's because of bond market and monetary policy uncertainty, and as a result, equity markets are moving with high degree of sensitivity to any Fed speak or economic numbers that come out. This is a divergence between the short-term policy, where we're seeing people step off the loosening policy, but we're at the same time seeing bond yields at the long end continue to rise higher. And next week we'll see the Bank of Japan review their policy. We're expecting them not to do much in terms of additional policy, in terms of easing, but we think they'll try to continue to steepen the yield curve, which is good for the banking sector, and start to reference more fiscal and structural policy in the way that they intend to grow the GDP numbers in that country. Because of this removal or central banks standing still in terms of further loosening, we think that the focus of portfolios and investors should move from that sort of passive strategy to more attention to structural stories within economies and sectors. So this month we've issued 2 new notes. One is a sort of general review of the supermarket sector, and one's a buy note on TJX. This week we saw John Lewis announce a significant fall in their profitability and halt their Waitrose store expansion, but reference, as this quote says here, far-reaching changes taking place in society and retail. In our review of the supermarket sector, we point to Aldi and Lidl being the chief drivers for that, and principally through the way that they're stocking their stores with far fewer products that are higher quality. So therefore you're getting much better inventory turn, far better margins, because they're sourcing fewer products on a global basis and bigger scale, and you're getting greater satisfaction because those products are higher quality. The clothing equivalent of that for us is TJX, which again is using a discount model, but again turning their store over very quickly, so the entire inventory of the store will be sold and restocked in 1.5 months. As you can see here, the comparable sales growth of this business has been remarkable since '86, with only one negative year in '96 when you think about the economic cycles we've been through during that period. And that's because in periods of austerity, the higher end brands can't sell through their usual channels, and therefore TK Maxx, as an example, in the UK will get access to better quality product, and therefore will receive more customer throughput. The other key retail story this week was the popularity of the iPhone 7, which has sold out globally, and T-Mobile referring to pre-orders being 4 times higher than the iPhone 6. The stock has had a very strong rally off the back of this, and what we're benefiting from here is very low expectations. So the base case for the Apple share price is a less than the negative expected performance of the iPhone 7, which appears to be happening, but then demand growing for the next super cycle, which will be next year in the next iPhone, and then more services onto their platform, which should grow their multiple in theory. The reason why we think the multiple can grow is that perhaps Apple is more of a luxury brand than a hardware story, and as we can see here from gross profit per user in the US, Apple per customer makes a lot more money. They have higher value customers that are repeat buyers, and I think we're seeing that coming through in the iPhone 7 sales. The other big story for the beginning of September, which is following on from August, was another bad move for Clinton against Trump in the polls. Clearly, Clinton is still significantly ahead in terms of being the most likely winner of the US election, but we are seeing a sort of Brexit-like moves in the popularity of Trump at the moment. Looking at the week ahead, there's very little in terms of corporate news flow, but as I said, the key focus will be on the Fed and the Bank of Japan. Thanks very much.